In the past 18 months, we have seen interest rates hiked 11 times, and now we're in this period of higher for longer. Higher interest rates have weighed on the real estate sector as a whole, among other sectors as well. Looking here at this chart, you could see the Vanguard Real Estate ETF, or VNQ, which is a popular REIT ETF. It is up only 2% in the past 12 months. Higher rates have really weighed on the sector. However, although inflation levels still remain elevated, interest rate hikes appear done with, and interest rate cuts are on the horizon, something that could be a huge tailwind to the REIT sector. As such, in today's video, we're going to take a look at 3 deeply discounted REITs that you could add to your watch list and buy in the near future. But before we begin, do me a huge favor, click that like button down below, subscribe to the channel, and let's get into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, you can go to fool.com/Mark to sign up for their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 3 deeply discounted REITs. Beginning with REIT number 1, which is Agree Realty, stock ticker ADC. Agree Realty is a retail REIT, coming public the same exact year of Realty Income back in 1994, making them very close competitors. Agree Realty currently has a market cap of $6 billion, and over the past 12 months, the stock is down 18%. Again, higher interest rates have really weighed on the REIT sector. Since going public back in 1994, the company has a compounded average annual total return rate of nearly 12%, and over the past decade, annual dividend growth of 6.1%. Now let's take a closer look at the portfolio, which currently consists of over 2,000 properties. Looking here, you can see top tenants include high-quality companies such as Walmart, Tractor Supply, Dollar General, Best Buy, and CVS rounding out the top 5. Those top 5 companies account for 22.6% of annual base rent. Top sectors include grocery stores and home improvement, which is no surprise given that Walmart is the top tenant, and then Home Depot and Lowe's are both on the top tenant list as well. This is a portfolio built of in-demand properties, evidenced by the large amount of investment-grade tenants. 69% of the portfolio, in fact, with another 15% that would be investment grade if they were in fact graded. Turning our attention to the dividend, you could see that the company pays a dividend of $2.96 per share, which equates to a dividend yield of 5.2%. The company has a 5-year dividend growth rate of 6.4%. Now looking at valuation, where analysts are expecting the company to generate AFFO of $4.11 per share this year, which equates to a price to AFFO multiple of 13.9 times. Looking out over the company's 5-year historical average, they normally trade closer to 20 times. That is a major discount. Even if the stock traded at 17 times, which is splitting the difference between the two, where it is now and where it has traded historically, we're talking about a stock price north of $70 per share. When looking at the average price target for Agree Realty, analysts have a 12-month price target of $67.50, implying 18% upside from current levels. That is a major discount we're talking about right there. Company trading at nearly 14 times AFFO normally trades at 20 times. Even if we split the difference between those two, we're still talking about a stock that could be trading near $70 per share. Right now, ADC trades at $57 per share. And that leads us to REIT number 2, which is NNN REIT, with the stock ticker NNN. They are formerly known as National Retail Properties, and they changed their name in the spring of 2023. They came public around the same time as Realty Income. The company currently has a market cap of $8 billion, and over the past year, we're down again, down 6%. NNN REIT is another high-quality REIT with great properties that are in demand, evidenced by their 99.5% occupancy rate to end 2023, a near perfect, fully leased out portfolio. In terms of numbers, NNN REIT is larger than ADC that we just looked at, as the REIT has 3,532 properties all over the U.S., with the majority being located in Texas and Florida. The REIT leases these properties out to more than 400 tenants. Here's a look at those top 10 tenants, which include the likes of 7-Eleven, Mr. Car Wash, Camping World, Dave & Buster's, and LA Fitness sitting at the top. However, as you can see when looking at rent exposure that each of these tenants have, it's much lower than what we just looked at with Agree Realty, which makes sense given the larger property portfolio to spread things out. In terms of exposure to top lines of trade, they include convenience stores, automotive, and restaurants sitting at the top. Turning our attention to the dividend, the company has 34 consecutive years of dividend growth, making it, as I mentioned at the start, the third longest of all public REITs. They currently pay a dividend of $2.26 per share, which equates to a juicy dividend yield of 5.5%. Although the high dividend yield comes along, the dividend growth isn't much, at less than 3% on average over the past 5 years. In terms of valuation, analysts are looking for the company to generate a FFO of $3.35 per share this year, which equates to a price to AFFO multiple of 12.6 times. The company has a 5-year average of 15.4 times. A REIT that is very cheap just based on recent historical average. But if we zoom out even further and go out over the past 10 years, a bigger sample size, the REIT historically trades closer to 17 times, which makes NNN REIT look that much cheaper. But let's say the REIT just gets back to today's 5-year average. We're talking about a share price that's closer to $52 per share rather than the $42 per share they trade at right now. In terms of analyst expectations, they have a 12-month price target of $45.50 per share on the REIT, implying 8% upside, which I believe is on the low end, but the REIT has very low analyst coverage, so make sure you take that with a grain of salt. And now we move on to REIT number 3, which is Essential Properties Realty Trust, stock ticker EPRT. This is yet again another retail REIT, one that we have not covered on this channel before, so it might be new to you. The company currently has a market cap of $4 billion, and over the past 12 months, the stock, or the REIT I should say, is down 2%, I guess making it the best performing on today's list. However, it has had a lot of momentum lately, up 20% from its October 2023 lows. You probably thought that NNN REIT had the highest occupancy rate to end the year. I mean, after all, it was at 99.5%. Nope, EPRT edged them out at 99.8% to end the year. EPRT owns a portfolio of 1,873 properties that consist of 18.7 million square feet of rentable space. As you can see on the chart to the right, the portfolio is well diversified amongst these various industries, with car washes and early childhood development being the two largest, two things that are safe from the threat of e-commerce. Here's a look at the REIT's top 10 tenants. I wasn't all that familiar with many of these names and actually had to dig into them a little bit more, but that's largely due to the fact that I'm here on the West Coast, and when you look at the portfolio map, EPRT properties are primarily east of the Mississippi. Now turning our attention to the dividend, where the company pays a dividend of $1.14 per share, which equates to a dividend yield of 4.6%. Although the yield is the lowest of the 3 REITs we're looking at today, still high in my book, it packs major growth with a 5-year dividend growth rate over 20%. Now looking at valuation, where analysts are expecting the company to generate $1.74 per share in AFFO this year, which equates to an AFFO multiple of 14.2 times, well below the company's historical 5-year average of 18.7 times. This is the REIT trading at yet another major discount. Let's just say the REIT gets up to an 18 times multiple. That would equate to a share price of $31 per share, implying 25% upside from current levels. Looking at analyst expectations, they have an average price target of $29 per share, implying 17% upside from current levels. But again, not a ton of analyst coverage, so again, take it with a grain of salt. So when it comes to investing in REITs, we were looking at AFFO multiples. Very important step to look at, but you want to dig into it a lot further. Do even further due diligence before investing in any of these 3 REITs. But in my eyes, I believe all 3 of these are deeply discounted, and all 3 should be high on your watch list because, again, we want to be ahead of the trend. When rate cuts come down, that is going to be a tailwind for the REIT sector. Down in the comments section below, let me know which of these 3 REITs that you like the best. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.